Episode number 5, highs that broke the lows and lows that broke the highs, draws on liquidity and turtle soup levels, real turtle soup levels. Now, this is another part of that liquidity masterclass, okay? Why are highs that broke the lows and lows that broke the highs important? A lot of liquidity resides at these specific highs and lows. This is due to market making and how smart money engineers liquidity for retail speculators and retail theories on price action, right? And this is where the understanding of the market efficiency paradigm comes in, right? Smart money is here, right? Uninformed money, that's all of us, right? Retail, and how they engineer liquidity for retail to see is what this is here. And we're going to be looking at some retail concepts to actually understand how smart money traps them. Okay, it is important to note that whenever liquidity resides, wherever liquidity resides, always has two functions: a level to target and a potential reversal level, a turtle soup level. Okay, this is with all types of liquidity, right? Wherever there's liquidity, it's a level to target and it's a level where price could potentially reverse from. Understanding retail market structure. So retail looks at the market in a very primitive way. When they're bullish, they just look at higher highs and higher lows. They switch to bearish when a higher low is broken, and they consider this a market structure break, chalk, etc. You guys know all these weird terms they've come up with over the years. Some of you might be familiar with them. When bearish, lower lows and lower highs. Switch to bullish when a lower high is broken. Market structure break, chalk, etc. Smart money will use this retail logic against them and aggressively cannibalize them, right? These lows that broke the highs and highs that broke the lows are extremely important levels because it's a foundation of retail market structure that smart money have created into the market, and all these books out there teach it, and everybody who doesn't understand what's going on uses these higher highs, higher lows, lower highs, right? And because it's so common, there is so much liquidity at these levels. Okay, so let's look at it in a retail perspective and then how we're gonna trade it. So we're bullish, retail are seeing higher high, higher low, higher high, higher low, high broken here, the higher high. What are they expecting? Now, if they're bullish, okay, they're expecting the higher low to hold, because in classic retail market structure, if you're bullish, the higher low should not be broken. And when it's broken, it means it's bearish, right? So this has two functions because of that logic from retail. It becomes an area to target because they have their stops here. Why? Because if it's bullish and they're long, this is a level, according to them, that shouldn't be broken, okay? Once price hits our higher time frame premium key level, we then look for the lows that broke the highs and target that, because there's tons of liquidity there because of how common this is as a price action concept in retail ideology. Everyone has heard of this, right? Okay, so let's look at an example of this. External range liquidity is taken here. We hit a big figure level, right? 24,000 is a round figure institutional psychological level, right? So when you're in all-time highs especially, these round figure levels become important key levels, okay? So we hit a key level. This candle, and it can be looked at as one candle or as a general structure, which I will show you as well. But this candle is technically the low that broke the high, okay? So this is a higher low. This should not be broken according to retail logic. So now let's look at the way retail looks at this bullishness. There's a low here, higher high, higher low, higher high, higher low, higher high, higher low, higher high. This is how they'd be looking at it. We know a high has been broken here, and this high is valid as well, by the way. This is the low, okay, that broke the high, okay? Very specific. We hit a key level, and where should your eye jump to? Your eye should immediately look at that low that broke the high, because that's where retail stops will be resting. The market then seeks the low that broke the high extremely aggressively here, because this is where retail have their stops because of that higher high, higher low, neophyte logic, okay? True turtle soups. Now, like I said, every area that has a level of liquidity okay, has two functions, right? The first was a drawn liquidity, which we just went over there. And secondly, it becomes an area to turtle soup. Why? Because we're going to reverse at levels where there's liquidity. This is where a higher time frame bias is important. When you blend this with a higher time frame bias, it's extremely effective, extremely effective. So when you see this in your chart, right, your eye should immediately start looking for lows broken when you're bearish, okay? When that low gets broken, your eye then wants to jump immediately to the high that broke the low, okay? So as a trader of mine, a student of mine learning from this course, this is what you want to train your eye to see, okay? You then anticipate a key level above the high that broke the low or the lows that broke the highs, and you anticipate them to get turtle souped if you're bearish. And this is a real, true turtle soup, okay? It's also, for those who have been with me for a while, double purge, right? This is where the logic of the double purge comes from, okay? It comes from trapping and cannibalizing the retail traders. And usually, okay, when you have these lows broken and the highs that broke the lows, when you're turtle souping those levels, you're usually going to see extremely low resistance liquidity runs, fast, volatile moves. Okay, so let's look at an example here. This is very recent price action from NASDAQ. We have this small dealing range here, okay, and a fair value gap is formed here. So we have a key level. It's also in a premium part of it, right? Now, just take a second here, okay? Don't deprive yourself of the learning. And just take a second, and what do you see here, okay? Okay, so what you should have seen, and if you didn't, it's fine. You're going to start training your eye to see this. A low is broken here, okay? This is the high that caused the break of this low, okay? This is what your eye wants to jump to as a level of turtle soup. True, real turtle soup is this right here. And what do you see after? Like I explained, extremely fast, volatile moves. Why? Because they're cannibalizing retail here. A lot of stops were placed above these lower highs, and that is why it's a level of turtle soup, and that's why the move as well is extremely aggressive and fast. It wants to cannibalize all those stops, because what happens here, right? Because we've broken through a lower high, retail are seeing bullish here, because a lower high shouldn't be broken through when bearish, okay? So there's a lot of stops here on both ends. If they're bearish, they've got their stop losses here, okay? If they're bullish, they've got buy stops here, buying on a breakout. So smart money are engineering liquidity like this, and this is what the market efficiency paradigm is. Another example here, and you guys will recognize this from the deferred delivery as well. We have a dealing range low here to a dealing range high, right? Premium high, discount low. Sorry, the colors are inverse here, but anyway. The market then, again, actually, what do you see here? Okay, start to train your eye to see this, right? Like if this was in live time, what should you be anticipating as a student of mine? High broken, okay? And look for the low that caused the break of this high, right? This is where you want to anticipate turtle soups to happen. We then have a key level below the low that broke the high, making it even more high probability. What happens next? Massive move, right? Like I said, you're going to see extremely low resistance liquidity. Like I said, you're going to see extremely low resistance liquidity run moves after the lows that broke the highs are taken, right? It's fast, it's volatile, okay? True turtle soup levels and true levels where the market will draw to. Why? Like I said, lots of retail liquidity at these levels. Okay, another example here, and those were continuation sequences, okay? Now let's look at it in the sense of a reversal sequence, okay, from this fair value gap. Let's look at it here on a much lower time frame. So it's a reversal on a lower time frame, even though it's a continuation on a higher time frame, right? This is how true reversals happen, right? Every reversal will not have this, but the highest probability reversals are going to have this, okay, period. High broken here. Engineered liquidity here. Low that caused the break of this high, okay, is actually here, my bad. This is the low that caused the break of this high. This is where the sell stops are resting, So you want to anticipate a turtle soup to form here if you're bullish. Then the market goes, accumulates the stops here. We confirm the order block by closing above these two down closed candles, retest, expansion.